Welcome to our 15th lesson. As usual, please take a few moments to pause and read the disclaimer. Today we are going to be talking about two important or let's say interesting things that one must know about the profile. The first one is the 80% rule. You will find a lot of people speaking about that and talking about it as a trading strategy. It is a phenomena that does appear or does occur occasionally. However, its name is appropriate for it in that it doesn't occur all the time, and you have to be careful. As with any trading strategy, there is nothing that is always 100% guaranteed or surefire in the market. You always have to be prepared and always have to have risk management with any strategy that you decide to employ. So we will talk a little bit about the 80% rule, and then next we are going to spend quite a bit of time talking about the overnight session, because it has a significant impact on what is going to happen. Many people, when the new trading day opens, seem to think that all of a sudden we have a brand new trading environment and a brand new profile is starting to form. That is not quite accurate. We are in fact having a new profile start to form for this trading session, but that does not happen or occur in a vacuum. It happens in the context of everything else that's going on in the market. And the overnight session, certainly, as you will see in our lesson today, helps us to put things in context and to learn a little bit more about what is likely to happen and the broader context for which the market opens. All right, let's begin by looking at the 80% rule. What does the 80% rule tell us, and how in the world do we trade based on the 80% rule should we decide to use it? The 80% rule states the following. It basically tells us that if there is there is an 80% chance that when the market opens or trades above or below the value area and then trades back in the value area for 2 consecutive half-hour periods, then the market has an 80% chance of filling the entire value area. Well, the best way really to see the rule in action is to look at some charts. So don't get bogged down in trying to read the definition. Let's take a look together at what that really is saying. If we begin by looking at the first premise of the rule, and that is that trading has occurred either above or below value. In this case, we have we're looking at a 30-minute chart. So this is 30 minutes. Okay. And prices are in fact above the value area high. Here's my value area high. Here's my value area low. Here's my point of control, price-based point of control, and price has deviated away from that. So we're trading above value. Now, what happens next as far as the 80% rule? We've established the first criteria of the rule. Prices have been trading above value. It could also be below, and we'll take a look at an example that looks at prices below value as well. But let's take a look here. So now, once price has traded above value, the second criteria in the rule is that we have 2 consecutive half-hour periods, 30-minute periods, that trade inside value. So take a look here. We have period number 1, and then we have another period, number 2. They're consecutive, they're right after one another, and they've penetrated back into my value area. So the second part of the criteria of the rule has now been validated, or we have 2 of the key elements. price trading outside, and then coming back in for 2 consecutive half-hour periods. Okay, if this is the case, what does the rule tell us is going to happen? Well, let's take a look and see. The rule says then that the market is going to fill the entire value area. Well, this is my value area, as you can see here, between the value area high and the value area low. And sure enough, take a look at what happened after these 2 consecutive periods. We get another bar that comes back into value and then continues on and fulfills the prophecy, if you will, or the 80% rule. We've now filled the full value area. We've gone all the way from the low, or the high in this case, to the low, and as a matter of fact, we've even extended a little bit outside of the value area. So knowing this phenomena and observing it in real time can be helpful in spotting or identifying for us a potential trade opportunity. That's the nice thing about the rule. Does it happen a lot? I really haven't done any specific studies to measure how often it happens, but it is true that when it does happen, there is a very high probability that that will be the case. Now, let's take a look at what happens when price trades below value. The first example we looked at, we had trading above value. So we were above the value area high. Here, again, we have a value area high, value area low, and we have our point of control. Now, in this case, this time, price is trading below value. As you can see quite clearly here, we are well below value. Okay, so what happens next? We begin to see in this 30-minute period, price penetrates back into the value area. All right, now what happens in the following period? Well, let's continue on and take a look at the next slide. We have, in fact, 2 consecutive half-hour periods trading back inside value again. Number 1, here's this big green bar, takes me right back into value. And note now, the second bar is a red candle, or it closes below the open of the candle. That's why we get a red candle, but that has no bearing on the 80% rule. It doesn't matter what color the candle or what happened in the candle. The candle basically tells us to fulfill, the rule basically tells us to fulfill the rule for the 80% rule, what we need to have is 2 consecutive half-hour periods trading back inside value. Now, and again, it doesn't mean that the entire candle has to be inside value. A portion of it, as you see here, that would fulfill the qualification or the stipulation in the rule. So we have one, it has traded back inside value, as you can see, followed by a second period that has all completely traded into the value area. Quite often what I have observed is some of the students, once they see the next 30-minute period begin, they immediately enter the trade. That's somewhat premature. Simply because it has opened inside value does not necessarily mean the rule is in effect. You really need to wait to make sure that the second condition has been fulfilled, that in fact you have 2 consecutive half-hour periods that have fully traded within or inside the value area. And our value area here is from the value area high to the value area low, the area that I have just highlighted. And sure enough, these 2 candles, number 1 and number 2, fulfill that criteria. So now take a look at what happens as far as once we have fulfilled the criteria. Sure enough, the market ends up filling the entire value area. Now, does this happen every time? No, but there is a high probability that this will happen. an 80% chance, if you will. And the 80% is more of a metaphor, in my opinion, that to define that this is a high probability strategy. And there is some logic, some sound logic behind the rule, and it comes by virtue of the fact that in the auction, now prices have managed to penetrate back into the value area. And so really the next challenge for the auction is to see if we in fact continue to the other extreme of the value area, what is likely to happen? Will we see acceptance in the market, or will we begin to see price rejection in the market vis-a-vis the value area? And this is sort of the logic around the 80% rule. So more often than not, the auction would prefer to continue moving in the opposite direction to evaluate acceptance or rejection at the value area parameters. And once again, this demonstrates for us the importance of knowing where the value area high is and where the value area low is. Sometimes this is neglected or forgotten by many traders. It is a very easy and simple strategy, as you can see. There is nothing complicated about it once you see it in action. The most important thing is not to get hasty with it and try to prematurely begin entering the trade. So now that brings up a very good question, and that is, well, how do we in fact trade this strategy? What is the best way to trade the strategy? Well, let's take a look here together at when price traded below value. Certainly when price is in this territory here below value, we could trade, or we could take trades, but they would be based on some other strategy. And I will talk about that a little bit in just a moment. But let's focus on our 80% rule. If in fact the criteria for the rule has been fulfilled, so I have number 1 and I have number 2 within value, the most conservative approach to this trade is the following. I would wait until prices exceed the high of the second consecutive period, and I would then place my entry. But the reason I said this was the most conservative, and by doing this, I save myself the gyrations or the potential return for a retest of the value area low, which often does happen and may happen in the market before we continue on higher. So don't expect that as soon as you see the first 2 consecutive periods within value, price is going to immediately skyrocket to the top. That is rarely the case. It does happen, but that would be the 1% rule rather than an 80% rule. More often than not, you are going to see some fluctuation in the auction before we fill the value area. So keep that in mind, and the safest, or perhaps the most conservative point of entry would be when prices in fact exceed the high of the second consecutive period. So I would enter here, and then my target would be up here at the value area high. Now the next key question would be, well, where would my stop be? And in this case, to adequately protect yourself, you really, and to allow the trade room to breathe, your stop should be at the low of this first candle. Now, unfortunately, in this case, there is somewhat of an exposure because of the extent of this candle. So you're looking at several points of exposure in the trade here. But if you think about it, you're getting into a high probability trade, and that's the right place to protect it, because as I mentioned to you, if in fact we end up with a few rotations in the auctions, we could come back down, come back up, and so on. You want to continue to be patient with the trade and don't expect it to come to fruition immediately. And you have to gauge whether your risk appetite would allow for this much in a potential loss. That is the conservative stop. Others may say, well, I'm going to put it at the value area low. If the value area low is penetrated, I'm out of the trade. But as I just demonstrated here, quite often this will happen. It will come down and then pick back right up again and head higher. In any event, I have also outlined for you the most conservative entry. Yes, it will be limited in terms of the profit potential, but it yields the highest probability of, or highest potential of success by taking prices once they in fact penetrate above the high. So as soon as price is higher than this high, I begin taking a long entry. Sometimes price will fluctuate in this bar. Maybe I can grab it at a price that's a little bit better than the actual high. If not, so be it. And I know that there's a good chance that we will make it all the way up to here, or the value area high in this case, since the rule is based on trading below value. Now, similarly, all the rules would apply in the case of trading above value. And so if I go back here and we want to take a look together at where or when I would actually begin to take my trade, in this case, again, here is interestingly enough, the second bar, the low was a little bit higher than the low of this bar, but it's the second consecutive bar. I would enter the trade here as soon as this low is broken. I am in the trade with a short in this case rather than a long, because of course the premise of this 80% rule is that price traded above value, and I would expect it to come back into the value area low for a test of the two value parameters. Naturally, the points will change and vary depending on what's going on in the market, but typically that is the general approach for taking an 80% rule trade. And here in this case, the stop, if you notice, would be at the high of this second consecutive candle instead of the low as it was in the other case. That would be where I would put my protective stop. And in this case, the risk to reward ratio doesn't look as bad as the other case that we looked at. And naturally, this will vary. There will be many variations in the market, and you should expect that. Now, some of my students sometimes will ask, why can't I just initiate my trade right here as soon as we are away from value? Well, one of the most important things, and we will certainly get into this more in the second part of the course in terms of designing trading strategies and looking at trading strategies, is you have to have an overall premise for your strategy. You have to be thinking about, why would I take a short here? Why would I take a long here? Simply by virtue of the fact that prices are now below value doesn't necessarily mean that it is time to go for a long. Because as you can see here, prices did in fact penetrate below the value area, and if you can see by the tail, a lot of traders decided to go long and actually pushed prices back up to this point, and we closed in fact above the value area low. So there was some responsive behavior here. The key question is always, what do I base my decision on? Is it simply that I've deviated away from value, so it's and I'm at the low end of the value, I should go long? No, keep in mind, look at what happened when all of these traders decided to go long. In the next bar, they were really all underwater. and prices continue to drop lower. So who's to say that value in the market is not changing and that we are in fact going to continue to drop lower and lower? Here on the chart we know what happened because we see it after the fact. But when this is live in the market, we have to be very cautious. So the logic that some traders want, or some new profile traders want to use when they begin using the profile, saying that the minute price deviates away from value, the minute price is below value, I am going to be long, or the minute price is above value, I am going to be short, in some ways is very dangerous logic. That is, sort of, I don't want to say misuse of the profile concepts, but I would say a misapplication. There is a right way to use the profile, and of course, as with all things in life, there is a wrong way. And that is the wrong way, or the wrong criteria to base your trades on. In the next part in our series, when we begin to focus on trading strategies, you will see that there are other parameters that we have to look at that can help us decide whether in fact price is going to jump back and go into the value area, or whether it is going to continue to move lower. And if we have those elements with us and we base the decision on a confluence of evidence, not simply by virtue of the fact that price has deviated away from value as our only criteria, then certainly that would be the proper and the appropriate use of the profile principles. So be very, very careful. Just because price trades away from value doesn't necessarily mean that, one, it will go back into value, or two, that it will continue to move away from value. What does it tell us in all circumstances? It tells us that there is an impending change in the market and that there are opportunities that could be had here. That's what you ought to get from price deviating away from value, that there is a potential for a trade. That's about it. Now, the direction of the trade, what's going to happen in that trade, and we need to look at a lot more parameters to be able to determine if in fact prices will continue to move lower, or prices will change and come back into value, and so on. And that's why the 80% rule was helpful, because when we saw that price came back within the value area, there was a high probability and a great likelihood that we are going to continue for a retest of the other value area extreme. So please be cautious and do not make false assumptions that immediately, because value is outside of a value area high, that prices are definitely going to come back into value. No. Conceivably, value is changing and we are going to continue higher. And as a matter of fact, in a bullish market, that is more often the case than not, that it is going to be continuing higher and higher, and that is the trend in the market, the overall trend, rather than actually coming back into value. And price will continue, and the other time frame framers, or the major traders, are pushing prices higher, and we are going to explore and look for a new value area. And if any of you have been tracking the market as of late, you have frequently and often seen that, because in fact in the past year and the years before it and so on, we have been on a rather bullish run. So keep that in mind. There are many different variables that one has to take into account, and don't get trapped into this idea that if I'm outside of value, I'm always going to come right back in. No. If that were the case, then it just the market would go nowhere. We would have a value and always going out, going back in, out, in, out. That may be true in a non-trending market, but whenever we have a trending market or any volatility in the market, that rule does not apply. So apply the concept of value area high and value area low to your advantage, and don't misapply them. All right, let's now focus our attention on the overnight session. Before we begin talking about the actual overnight session, it's important to understand that each day session is within the context of the broader 24-hour market. Now, we are seeing a trend with the electronic markets and the electronic exchanges that probably before not too long you're going to find that all markets technically will become 24-hour markets. However, for now, in the futures market, the three indices are a 24-hour market. The S&P, which is of course the Standard & Poor's 500, and many people prefer to trade the ES mini version of that. Then we have the NASDAQ, which is the NQ, and we have the Dow index as well. In addition to the US stock futures that are trading 24 hours, it's important to recognize that there are other major markets around the globe, and certainly even when our markets are closed, they are active, and what happens there often will have an influence on what is going to happen when our market opens. Now, Forex, anyone that trades Forex or is familiar should also know that that is a 24-hour market all over the world, even though there are different sessions, but it too is a 24-hour market. The key foreign markets that you should keep an eye on are the Japanese, the Nikkei, the Hang Seng in Hong Kong, and the FTSE in England, and of course the DAX. And there are many traders in the US that choose to trade some of these markets, especially the DAX. For the Forex market, I just want to do a quick review of the key sessions in that market. There is, of course, the London session, which is usually the most active session in the Forex market. Then, of course, we have the US, or what's often described as the New York session. And then we have the Tokyo, or the Asian session. The three key sessions within the 24-hour cycle for the Forex market. And naturally, you need to be aware of that if you're going to trade Forex, and you need to know which session you're trading, and you need to take a look at the impact of each of these sessions on the others as the market cycles through the 24-hour cycle. And of course, we talk a lot more in detail about this in our Forex courses. All right, let's now take a look together at the actual shape of a 24-hour profile. Naturally, the 24-hour profile will be made up of both the overnight session as well as the day session. So it is a composite profile, if you will, for both sessions. Now, you will find that a lot of the parameters that we are familiar with will appear on a 24-hour profile, just as they do on the day session profile, except in this case, if we take a look at the initial balance, since the 24-hour profile typically begins with the overnight session, the initial balance that appears here is the initial balance for the overnight session. And naturally, the overnight session has quite a bit of activity at night. It's usually a little bit slower and the range is tighter, but in this case it looks like we had a price that was visited quite frequently during the overnight session. The overall value area for the 24-hour period, of course, is defined on the 24-hour profile. We have a value area high and a value area low. But in this case, it's not only for the day session, it is for the 24-hour period. And it is always very important to look at that value area for the 24-hour period, or look at the value area of the day session relative to the value area of the 24-hour period. And we will look at that together in a moment. In addition to the POC for the evening session or the overnight session, we also have a volume point of control that appears here, and we have the parameters for the actual volume-based value area down here. The cyan lines, there's the value area high based on volume and the value area low based on volume, and here's my volume point of control for the 24-hour period. Now, if you notice, the volume is concentrated down here, and typically this will identify for you where the day session is on the 24-hour profile. The evening session typically has significantly less volume than the day session, and therefore we often will see more frequently than not the volume point of control on the day session. So interestingly enough, relative to the value area of the 24-hour period, in this case we have the day session rotating or below and actually closing the end of the day session below the 24-hour value area low. That is always interesting information, and not only interesting but useful information in preparing for an understanding of what may or may not happen in the upcoming 24-hour session. Now, the question that I would like everyone to answer quickly for themselves is, what type of structure do we have for the 24-hour period? Well, we have a double distribution. It should be evident to everyone based on our prior lessons. This is the distribution that took place during the overnight session, and right below it we have the distribution that took place in the day session. So from this double distribution, we can also say that we have a B, the letter B, capital B shaped profile. And what does this B shape or double distribution tells us? Well, in analyzing the 24-hour profile, there was definitely significant negative sentiment in the overnight market, and that influenced the open and the day session by dropping the range lower, and now we ended up with a distribution during the day session that was below the distribution that occurred in the overnight or the evening session. So by also analyzing the 24-hour profile, we can garner a lot of very valuable and useful information that helps us to begin to think about what is likely or not likely to happen in a future session. So when you put the overnight as well as the day session together, you get the 24-hour profile, and you get a full context of what's happening throughout a 24-hour cycle. If I broke up the profile that we were just looking at, it would be broken up into two key parts. The overnight session, of course, up here, the first rotation that we looked at, and then we have the day session, and that would be the second rotation. Now, take a look at what happened here. We closed down here, we open the day session here, prices come back up for a retest of the evening value area, we have rejection, and prices continue to drop lower. This is all within a 24-hour market. As they continue to drop lower, we begin to develop a new rotation down here in this price range, and that gives us the double distribution shape that we ended up once we did the composite. So this is what each session looks like independent of the other, and this is what the two of them look like together when we merge the profiles and look at them as a complete 24-hour market. All right, let's go back and focus on the overnight session again, because as you will begin to see, it offers us some valuable insight into what is going on in the market and what is likely to happen in the day session. So don't ever underestimate or sort of belittle or ignore the overnight session. Now, some people even like to trade the overnight session, although the activity in that session is typically very slow and takes quite a lot of patience. Nevertheless, it is a valid session, and it's there, and it has an influence on what is going to happen in the next session. So let's take a close look at it together and see what kind of information does it give us and how this can help us in preparing for trading on the following day session. Well, we've identified the session, and here we're going to we always have to look at it in context of the preceding session before the overnight the other day session, in other words, to be able to analyze it appropriately. Of course, this new session hasn't happened yet. We want to know what this new session is telling us, and to do that, we definitely have to go back and look at it relative to what had happened before. Now, with that in mind, we're going to begin with the prior day's close. Naturally, since this is an evening session, the session that preceded it would be a day session. So this was the full day session for the prior day, and that session ended up closing where? Below the value area low. And as we've been discussing and as we have learned, when we are outside of value, the opportunity and the potential for a trade often presents itself. In this case, the first question that we want to ask ourselves, if in fact we ended up closing the day session below the value area low, what was the sentiment during that day? And the answer should be obvious. The sentiment was bearish or negative. Otherwise, we would not have ended up closing below the value area low. And so now the question that needs to be answered vis-a-vis the overnight session, will in fact the overnight session continue to take prices lower, or will responsive buyers come in and pick up the price and lift it back into the value area of the prior day? And this is the question that immediately the overnight session will answer for us. As you can see, the answer becomes very evident when we take a close look at the overnight session relative to the close. Most of the overnight session is in fact trading below the close of the prior day. So in other words, we were never even able to penetrate back into the value area of the prior day. So the significant conclusion that we can immediately arrive at from studying the relationship of these two sessions to one another is that the negative sentiment continued to be in the market within this 24-hour period. I don't want you to think there's a meltdown, or you always have to analyze things in the context and not to over-project. This is between the overnight and the day session. So relative to the day session, we continued to move lower, and sentiment is still bearish in the market. Now, we haven't even been able to penetrate much into the value area of the day session, and now this gives us another important tidbit or important fact. The bearish sentiment is strong. We have a ledge here. You can see we've tried to come back into value, and every time we tried, 4 different times in the overnight session, each of them failed, and we were never able to penetrate back into value. This is the insight that only the profile can give you. So now when you take a look at, because the profile identifies for us where that value area is. Without that parameter, we wouldn't be able to know that in fact the overnight session never managed to penetrate back into the prior day's value area. So that tells me something very important, and that is that the bearish sentiment is still strong in the market. And ultimately, look at what happened. We have this rotation still below the value of the prior day session, and we end up closing at the low of the overnight session range, pretty close to the low. This is where the overnight session ended up closing. Now, another important element that I want to make sure that you are aware of from the day session is the settlement period. Not only do we look at to what extent did we penetrate the value area, I also like to study and to see to what extent did I penetrate into the settlement period. And the settlement period is the letter N during the day session, or the very final 15-minute period of the day session. That N period is very, very important. You need to look at that closely relative to the overnight session. How much of it was overtaken by the market can be indicative as to whether a bullish or a bearish sentiment is continuing or in the market or changing. Of course, if we were able to come back into value and most of the rotation was up here, my inclination would be to think that the market is going to continue and move back a little bit higher, or at least to test some of the areas that were above here. However, in this case, we weren't able to make it much above the value area low, and furthermore, I am only 3 clicks or three ticks, 3 price levels into the N period, and I did not have much of a penetration into the N period. Again, another reaffirmation, another tidbit, if you will, of important information that the sentiment in the market is still very bearish, quite a bit bearish. Now, armed with this important information, if I am preparing to trade the day session, and I'm looking at the early morning of that day session, what are my biases? What am I looking for? And this is where the overnight can be incredibly helpful. Okay, I know that the market has been bearish. So now I need to establish whether this market is going to continue with that bearish sentiment, or if in fact the market is going to change and we're going to begin to move back into the value area of the prior day session. So now we get into the fourth element of the overnight session analysis. The first couple that we looked at were, first of all, where the prior day's close was relative to the overnight session. 2, we began to look at the value area of the prior day and how much of the overnight session was able to overtake that. And 3rd, we looked at the settlement period and how much penetration prices managed, or inroads prices managed to make into the settlement period. Now, 4th, we want to actually study the auction flow, how prices sort of behaved during that overnight session, and this is really the perhaps going to be one of the most revealing and telltale signs of all. Take a look at the rotation with me. We came back, we opened up here, we dropped lower, and then B period was very tight. The market continued to drop a little bit more, came back to test the value area high, failed, came back to value area low, failed to move lower, came back up, consolidated in this area, gave it one more push upwards, that also failed, came back down, came back up again, and then started to drop. Dropped well below value, was picked up when it dropped outside of the overnight value area, came back higher. Now it wasn't even able to make it beyond the point of control, either the volume point of control, which is the black line, or the time-based point of control, and look at what happened in G, H, and I periods. Towards the end of the session, the end of the overnight session, prices drop even lower and extend the range one tick below, and we close right here. So now, when the market opens, there is, of course, the potential for it to come back for a retest of value, or it could continue lower. Now let's take a look at what happens. The market actually opens right here, where, of course, the overnight session closes. And a period begins to take prices lower and then moves a little bit higher. And really, a period, if you take a look at the range, it certainly was extended lower, came back up, didn't even make it into the value area low. Look at what happens in period B. Once again, opens a slightly higher open than A, goes up for a retest of the value area low, manages to make one tick above it, and then we're still, in an area with that range well below the value area low. C period opens and it can't make it anywhere above the value area low. So obviously during C period we begin to see a continuation of the negative sentiment. So since I knew that the market was bearish and prices were continuing to drop lower, my bias at the beginning of the day should have been, well, the market is bearish. And I would have been looking for an opportunity potentially to go short. When did that opportunity present itself? It is hard to sort of see that on the profile chart. So let us shift gears a little bit and take a look at the action from a different perspective. And this is something that's important and something that we will certainly do a lot more of in the next course, in the follow-up course to this one, which is look at the trading charts in addition to, or in tandem to, the profile charts. Integrate both of some of the technical knowledge that we know about price and price behaviors with the data and the valuable information that we can extract from our profile. And this is really where the power lies, in being able to integrate that combined knowledge. The person that has only the technical analytical skills is missing a very, very big part of the equation, and that is the valuable data and input that the profile gives them. Now, when you have the data and the information from the profile in addition to the technical tools, you have a very powerful combination, and as we will demonstrate shortly here. So to do that, now I'm going to switch gears and go back to technical analysis. And very simple. We're really looking at the same thing that we were just looking at, except of course we are looking at it from what I'm going to describe as a candlestick, or what I also like to call my trading chart. So yes, I do use the profile, and the profile is incredibly valuable, but my trading charts are candlestick charts because they show me some other things that are also useful and helpful in addition to what I'm getting from the profile. So simply put, we have a very, very simple chart here, the different candlesticks, and I have a simple 20 moving average, and I have a simple 50 moving average on the chart. Okay, there is my 20, it's the blue, and there is my 50. In addition to that, you will see a whole bunch of numbers on my chart. These happen to be the total volume at each of these price levels during each of these 30-minute periods. So this is a 30-minute chart, and the numbers before you are all the volume levels at each of those prices during each of those periods, something that we've looked at before. But they have a different use, but we will not talk about that right now. Let's focus on what we want to extract from the technical chart in addition to the profile. Now look at what I'm going to do next. I am now going to superimpose my profile on this technical data, and the profile that I have is in fact the overnight profile. So here's my overnight profile right here, and this is what the market rotation or the auction looked like, which we just looked at a little bit earlier. Came up here, came back down, came up here, and so on, and this is where we ended up closing. And then we're going to answer some questions together. All this so far is very simple. It's just a matter of being able to use different tools and integrate them together. We have the 50 simple moving average, the 20 simple moving average, and the overnight profile with the point of control, the value area high and the value area low. And I haven't really identified all the different elements on the chart. I'm hoping that by now, since we are on our 15th lesson, that it would be easy for anyone to identify where those elements are. Value area high, value area low, and here is my volume point of control. So the day session is about to open, and I am armed with this valuable image or this valuable chart. My first question is, what is the market sentiment prior to the open? And it should be very obvious, it is bearish. Now, we established that from looking at the profile a little bit earlier. In addition to that, let's take a look at some of the technical analysis and what it tells us. I have a high that was established up here. I have a low, and then I have another high and another low. And the interesting thing is lower high, lower low. That indicates usually a downtrend, indicates pressure to the downside. So we know that the sentiment is bearish. Is that enough for me to jump in and take a short entry immediately? Absolutely not. We've established the sentiment in the market, but that is not enough to for us to act or react. We really don't have enough information, or at least a prudent trader needs to be a little bit more patient. At what point, and the question now that begs to be asked is, at what point would we know, or would we be able to identify that the sentiment has changed? Meaning, what would lead me to believe things are no longer bearish, and that in fact things are now bullish? And there are several easy answers. If in fact we begin to see prices trading higher than this level and higher again than this level, to establish that direction has really changed, the bottom line is I have to make a higher high than this last high that was made. So if I am higher than this level, I am now confident that we should be, if I've created another high that's higher than this, definitely we're probably looking at a market that is likely to change in direction, and things are going to move, to continue moving higher. In other words, the trend is changing. I've made a higher high and a higher low on this end, so now we're in a more bearish sentiment market. If I am a little bit higher than this high, not necessarily so. Conclusively, if in fact I have taken out this high with a new high and this low with a higher low. What would help us gauge the strength of the current sentiment? This is an excellent question, and on this chart we really don't have all the elements to help us with that, but I'm going to add a tool shortly that will help us to gauge the strength of the current sentiment. A big element, of course, is volume. How much volume is pushing in the direction? Which price levels would provide potential profitable entries? And that's really the key question to help us guide our trading decisions. Where would we begin to want to take some profitable entries? Let's take a look at the next slide together. And I've added another tool that helps us to gauge the strength of the trend or the sentiment, if you will. And that is the Keltner. Well, the Keltner is a simple technical tool. It involves two bands around a moving average. And in this case, my two bands are applied around the simple 20 moving average. This is the Keltner high, and this is the Keltner low. And I have set the settings based on the 20 simple moving average and two standard deviations. When prices are trading significantly outside the two standard deviations and above, the trend is quite strong. If in fact the trend is staying within the two standard deviation, it is not that strong. So here, take a look at what happened when prices actually deviated and sort of dropped below the two standard deviations. We came back up to the 20. Prices dropped back in again, and so the question now is, will we continue with this same type of intensity, or are prices going to be more intense and drop lower? So if someone jumps in and wants to take a short immediately, as soon as the market opens, for me that would be a high risk trade. It would not be a conservative or a prudent move. Yes, it's only based on the fact that market sentiment is bearish. And then if you do that, the reason I label it as high risk, your stop probably ought to be here. If in fact prices come all the way up there, things have changed, and you should be that's when you should be you should take your hit and basically exit the market. Now, which price levels would provide the best potential profitable entries? Well, let's use our profile now. We saw that when prices came back up to here, they dropped back down. And also at this level, prices dropped back down. So those would be the two levels that we would look at. If prices come to them, there would be a good potential for a short. Again, keeping in mind that my stop will be up here at this high that was established. Now, let's take a look at the day session open and what actually happened. Here's my value area low, value area high from the overnight session. The day opens, comes back slightly into value. Okay. Now notice I have another bar, another half-hour period, that also comes back and trades within value. And I generated this example, or I selected this example. I didn't generate it. This is actual market data. I selected this example because we spoke earlier of the 80% rule. And notice how now we have two consecutive bars that have come back into the value area. All right. But look at what's going to happen now. Both of them are trading back inside value, but take a look at how prices drop significantly. So I also wanted to demonstrate to you that the 80% rule doesn't always work. There's a certain, and that's why it's 80%, not 100%. But back to our original case of when it would be a good time to enter this trade. Well, the first spinning top indicated sort of uncertainty. Buyers came in here and tried to push prices higher. And in the second period, we end up establishing a higher low from the prior low and a higher high. So now we have a lot of people thinking we are going to move back up into value, the 80% rule, and look at what the market does. It traps them and starts moving lower. So when would I have been willing to take my short? I would have been willing to take my short after seeing the first half hour, and when in fact we drop below the low of this second period in our first hour. This is the point that I would select as a conservative entry for a short, and in doing so my stop would be up here. Prices would continue to drop lower. I would have to pick my target based on prior profile parameters or the 24-hour parameters, and again we discuss some of those in our next course when we talk about strategies in more detail. Now let's put the Keltner back on the chart as we did here and take a look at what is really happening here. We opened here and we talked about taking our short here, and we would have had some gain here. We're beginning to see a consolidation here. Now notice, when prices deviated away beyond the 2 standard deviations, we started to see them come back up, but they dropped back down again. So we're beginning to see a support level. Have we established, in fact, a change in sentiment? Should I be thinking about longs now? Because I see probably the other time frame buyer has come in and bought here, and there's a support level that is developing. Well, it depends. If you're an other time frame trader, that may in fact be the case. You may do that. However, if you are a short-term trader or you're trading the day session, getting into a long position in this non-trending or rotational part of the market is somewhat precarious. You might get trapped one way or the other. So what we have here again is a non-trending. So we trended for just 2 periods, and then we got into a non-trending market. It's very important to be able to read and sort of understand the shifts in the market and not to prematurely react to them. Certainly, if I'm well below here, way far from the second standard deviation, I should be. This would not be a good time to be in a short. Even if I don't want to take a long, I certainly should not be taking shorts down here, which many novice traders, this is a very common mistake that they do. They're afraid to take the short. They wait for a confirmation. Now after 2 periods, they say, okay, now I'm going to take my short, and they begin to take the short here, and they end up losing quite a bit on it because this had deviated quite a ways from the second standard deviation, and it was really just time for the market to rotate back upwards. And then the market rotates, and then it turns back down, comes back again, and this is when people get whipsawed. And so you really need to learn to time the entries and select the appropriate points for the entries. And this again is where the profile helps us. So if we look at the profile relative to what's happening in the market and begin to see the new day profile, and we begin to ask ourselves, are we seeing a change in sentiment really? And the answer is no. We're just seeing a support level and the market wanting to rest and finding a stop price. The change in sentiment is not there yet. That concludes our lesson for today. And as usual, I welcome your questions.